Hello folks, how are you? What's up, traders? Hope you guys are doing very much better. It's another time here at Ghettos FX. We have something to look upon today. We have had a macroeconomic report released by the Central Bank of Switzerland. It's all concerning CPI, Consumer Price Index, as an index which reports the inflation state concerning the Switzerland. So whenever we get these reports like these, the authorities release these reports to the public. The various users of these reports, like I always in my classes when I'm training, I insist like the users of financial reports are not merely financial speculators like as traders, but it intends to deliver the message and data for various other stakeholders for decision making, like the government itself needs these reports in order to implement government policies and plan. Investors as well need these data, citizens of particular states, people who are engaging into trade with that specific country. Also, they need to have data like this because you cannot just make a decision to invest in a foreign state, whether domestic investment or foreign investment, without understanding the critical macroeconomic situation of that particular state. That's why it's very important for the legal authorities to have releasing this data into the public. So today's around 9:30 a.m. East African hours. We have had a news concerning inflation from Switzerland, whereby in the previous month it was reported 0.3%, and the consensus expectation is that inflation would have remained the same, 0.3%, and eventually the actual report when released, inflation was just the same as it was anticipated. So what does it mean in terms of economy, and how does it reflect the forex analysts or financial speculators with respect to the demand supply of the currency, specifically CHF currency, and the economy at large? You know, there is a certain rate of inflation which is suitable for the economy performance. Always we say a stable nation is the one which at least maintain an inflation rate which does not exceed 3% and does not go beyond 0%, because when you have a negative inflation rate, that means you are having a deflation that wouldn't attract investors. The same as if inflation increases over and above 3%, it calls for the alarm to the government and the central bank to take immediately initiative measures to bring it back to a normal, steady and efficient rate of inflation. So once data like this being released, it has been the same. First of all, the inflation rate has been reported within the scope of range that is economically efficient. It doesn't exceed 3%, and it doesn't go below 0%. That is not negative. Then let us go and look at the history, at least for the first quarter, of this year. You see, in January it was 0%. In February, it was 0.2%, although it was less than anticipated, 0.6 by 0.4% difference. In March, it was positive 0.6% within the steady rate of inflation rate, but it was over and above the anticipated rate. That's why you can see it is positive for a normal mere person who doesn't understand the economic impact of data like this. Would just think a decline in inflation is better for the economy, but you need to understand there is a certain percent which is allowed, and the logic behind it this: investors prefer to invest in an area where prices at least keep on increasing in a rate which is not harmful to the economy, so that they can know their investment has a guaranteed profit making in a short run or in a long run, contrary to the area where prices keep on declining. Eventually investors shall not be interested to invest in that particular state, and especially if the nature of the investments are globally competitive, or they can invest anywhere in a competitive environment. So if you look at March, then inflation dropped down to 0%. It didn't go to a deflation rate, but it was below the previous months. It was below the consensus expectation. Now, with this month's prices just maintain what has happened in the previous months. Like, let us look at the graph. Even if we look at the graph here, we can see Switzerland came out of deflation for the last quarter of 2023. August, October, and December, there was a deflation which hit about negative 0.2%. So I think the macroeconomic policy makers, the government as well, I think with the central bank, have just done a good thing to return back the inflation at least into a steady and normal efficient rate. As we see for the whole first quarter of 2024, inflation is still within the normal street rate, although there are some fluctuations like we have seen here. We have the negative and increasing and declining because we don't have a negative. The moment the CPI is negative, that means that is a deflation. So at least I think the central bank is doing a good job to maintain it. But now, how does it affect the performance of a state? Like, look at what happened last year, the last quarter, when we have had a deflation. Go to the chart and look there, like Euro CHF, since December, January, coming to this April. You see from the monthly time frame, Euro CHF, this pair has been buying. This pair has been bullish. Why? Because of this effect of inflation. But now, what happened today? Today, we see there was a constant rate of inflation being reported, and you see this bearishness that we see is just because of this news. This news was released at 9:30 a.m. Look at this 1 hour candle. This pair has been selling just because of fundamental, but I don't want to talk about technical analysis, where will it sell to what point, or whether we are going to have a reversal or otherwise. But what matters is to understand the importance of macroeconomic report with reflection into what's happening into the market. As a financial speculator, this is very necessary and very important to get to understand. So all right, guys, thank you for watching, listening. Until next time, see you. This is GetSource FX.